Hey, welcome to our Market of the Moment update, week of July 11th, 2022.
Let's
Michael
go.
Oldham with Chris Madrid. What's up? What's up?
Charts here in a little bit, but rates in general are better than they were 2 weeks ago, right? But slightly higher than they were last week, which is just one of those things that we talk about that happens from day to day and week to week. So from a traditional, if you're looking at a conventional loan, right, conforming balance, which is in most of DFW, that's a loan of 642 and below, right, is a conforming conventional loan. You're going to be in the probably 5.75 to 6% range. Is where we're seeing most of those offerings. FHA has always been, a little bit lower than conventional, and because the market has slowed down, we're now seeing more FHA offers get accepted, more VA offers get accepted, which is great, because those are when the market's boiling hot like it's been. Those are the last ones those offers get accepted last, right? They're for whatever reason there's just a negative connotation with them, and it's more difficult to get those accepted. But now that things have cooled down a little bit, those offers are getting accepted, which is great. So FHA rates we're seeing in the low five, so probably 5.25, 5.6, something like that. And then one of the things that we've been talking about a little bit more and more is the conventional ARM products. So you can get a lower fixed rate, but it is over a shorter period of time. Now, this isn't the pay option ARMs that that were in existence back in the 06, 07, 08 days, right? These are you still have a principal and interest payment just like you normally would on any other loan. The difference is you have a lower fixed rate for a specific period of time. So on a like on a 5-year ARM today, you can get something in the neighborhood of like 5%. So you'd have 5% fixed over the next 5 years, and then that interest rate could then only adjust once after that initial 5-year period. So you're not going to have multiple increases in a year, right? So if it changes once in that year, that's where it's going to be for that following year. And then it can go, there's caps and maximums that it can go, but ideally where we're having conversations on these is, okay, you're taking a 5% rate over the next 5 years. The likelihood of rates coming down in the next 1 to 2 years at this point is very likely, right? Where we're going here in our next conversation is we are either in a recession or headed into a recession. And typically, historically, mortgage rates then come down after a recession. Yeah. So you take a 5% rate on a 5-year ARM today, and then again in the next year or two, we're going to refinance you out of that into a fixed rate option. So again, just some options, right? At the end of the day, we want to just make sure that our customers are educated, they know what they're looking for, or what's out there and available. So that's where we're at on that. As of, we can actually we'll go to the charts. Yeah, this morning stocks and mortgage bonds were sharply lower, right? We had the hot inflation numbers that came out, and the producer price index, the PPI, which measures like wholesale inflation, rose 1.1% in June, which expectations for June were about 0.8, right? So it kind of blew past that 0.8 expectation, and it rose 1.1%. And then year over year, PPI rose from 10.9 this time last year to now it's sitting at 11.3. So if we're looking at that July date, and of course July 18th, which hasn't happened yet, but this is the most recent activity that we're looking at. It's essentially back on the 12th. Was when we're giving direction to lock in rates as mortgage-backed securities dropped yesterday, and then again today we're down at this point. So again, it's super important when you're working with a lender or loan officer that they know obviously what the market's doing, how things are moving and shaking, and giving you the best opportunity to lock in the lowest rate options available. So
Definitely.
next slide. Yeah, no, so this came out earlier this week, but man, we can clearly see when I saw it come out, I was just like, holy cow. We're looking at, obviously the big headline is, year over year consumer price index, which is essentially the cost of goods, right? Milk, gas, energy, food. I mean, those are all those things that are factored in there. And we went from this time last year was 8.6, and we are now up to 9.1. So rents we saw go up in the month of June, 5.8%. Energy, right, what it costs to heat and cool your home is up 42%. And we all know at the pumps, right, we can all feel it at the pumps. Gasoline prices are up 60%. Food's up 10.4%. And crazy enough, if you have a vehicle sitting around, you can probably get a pretty penny for it. As used cars year over year was up 7.1%. So just again, this is when we talk about inflation, this is what we're referring to. I mean, it's essentially just the cost of everything that has gone up month over month, and then again we can clearly see even year over year, just the cost of everything is going up. So based on these numbers earlier this week, based on the PPI numbers this morning, the Fed was already talking about in a couple of weeks when they go to discuss and talking about bumping the federal funds rate, that they would be going up 50 to maybe 75 basis points. Now, it seems like based on these numbers, I mean, 100 basis points isn't off the table, right? So that, well, again, what we've talked about before, that means your credit cards are going up, student loans, car loans, again, all of those shorter term financing options out there, the rates on those are going to be going up. And from a car loan perspective, if you bought a car, a year ago, 2 years ago, 5 years ago, that interest rate's fixed, right? So you're not worrying about those. But again, your credit card rates are not fixed, right? Those are variable, so those can go up. And again, anything that is not an actual fixed term with a fixed rate and a fixed payment, those are the ones that you're going to see go up. So again, as things start to, as we're still seeing the cost of everything going up, again, we encourage, we can, obviously everyone that tunes in and watches, get those credit cards paid down. Just make sure anything that's on a variable type rate, you try to get that paid down, and then again, not use it, because that is what's going to cost you the most. If these credit cards get up to 18%, and you're already paying less than interest, right? When you make a credit card payment, so you're not even paying an interest payment, you're paying a little lower than interest. So you have just this compounding effect that you're never going to get out from. So yeah, first things first, get those, quit going to Starbucks, quit doing whatever crazy expenditures that you have, get those credit cards paid off so that you're in a much better financial situation.
Cool. Just to tag on the back of that, the energy 42%, I have a feeling as we get into winter that number is going to drastically change. I've heard stories the last couple of days about how much heating homes and things of that nature is going to cost this winter. So we're barely feeling the energy part of this, I believe, right now. So
yeah,